Hello everyone and welcome to the final income estimate video. In this case it's for John's retirement portfolio in 2024. Um, let's just jump into the numbers. I think everyone, if you've watched the previous videos, kind of get the direction that this is going. Let's take a look and see what we have. Always err on the side of safety. I would rather underreport than overreport. And then also the initial estimates look a little bit on the bleak side, and a lot of that has to do with the fact that I am excluding certificates of deposit and money market income from the initial estimates. I add those back in later. But that's one of the reasons why you'll notice that things look to be heading in a not positive direction initially. So as far as 2023 versus 2024, the thing that you'll notice here is that I jumped the gun a little bit in getting my January numbers updated. And so compared to the previous videos that I made, 2024 in the month of January, you'll notice it's highlighted with green. And that's because that's an actual validated number in terms of how much income was actually received. And that number is going to include uh, certificates of deposit and money markets and that, but anything in yellow is going to be something where we've excluded certificates of deposit and money markets. And the big difference between this video and Jane's video for her account is that, especially in her traditional IRA, she has a very high dependency on certificates of deposit and money markets. So you'll notice here that the fluctuation in terms of the estimate for the growth in the portfolio is not as significant as it was in Jane's. I mentioned before that what I like to do is I use the previous history to kind of come up with a little bit of a baseline. The thing about John's portfolio is that it was definitely hit harder during COVID in particular. But as you can see in 2023, there was actually negative growth. But in that, I've also explained in the previous videos that a significant amount of this was related to the Healthcare Realty acquiring Healthcare Trust of America. And so the thing is that if we removed that, we would have actually seen positive year over year growth. And I apologize, that was in 2022 that happened. So 2022 wouldn't have seen as significant of growth because that happened here in the month of July. And so we would have seen, I think it was about a positive 8% growth, 9% growth, somewhere in there year over year, if that would have been removed out of here or excluded. But overall, we're looking at a 5-year average of about 15.3%. But there's been quite a bit more variance in terms of between the highs and the lows as compared to Jane's traditional IRA, which has always been in the double digits. And then for the Roth IRA, and also I forgot to mention this in 2024 again, this income part right here has been verified. But what you can see here again, the difference between the highs and the lows. During COVID, John's portfolio took a bigger hit, in particular because there was a couple of real estate investment trusts that their dividend had been slashed a little bit. So that's the big reason why we see much lower low and then some of these higher highs, was because once they recovered, then they were able to start paying out dividends again. And obviously the recovery has been pretty good since 2022. But we're looking at about just under 13% is the average growth. So now when we look at the projections, just like with Jane's account here, we're looking at in the traditional IRA, basically with no CDs, no money market income, and no dividend increases, we'd be looking at a reduction of 6.6% year over year. But when we factor in the amount of cash on hand and then also cash that is currently invested in money markets and certificates, that's when we're looking at about 2.6%. This number, though, also is still excluding any dividend increases in the portfolio over the course of the year. So basically, if everything remained the exact same and we continually had the money invested in money markets and CDs, we would expect a slight growth in terms of the income generated. But once we look into the 3%, 5%, or 7% increase averages, that's when we're looking somewhere between closer to 5.4% up to 9%, which is actually sounds pretty reasonable to me in terms of what expectations look like there. And then for the Roth, same rules apply. On this one, though, we're looking at about a 7% decrease year over year with no dividend increases, no certificates, no money markets in terms of income being generated there. Once we factor those in, that takes a pretty drastic swing. Part of the reason why it's taking such a big swing here as compared to the traditional IRA is that you have to also remember that the traditional IRA has significantly more holdings than the Roth IRA does in terms of just the size or the balance of the account. So in this case, you can move the needle a lot more, even though the amount of CDs and money market income is not substantially more. I think it was about $20 a month extra. And then once we look at the 3%, 5%, 7%, that's when we start looking at between somewhere from about 13% up to 17%. Again, a lot of this is being attributed to the certificates of deposit and the money market. So I think that that's going to play a big factor in terms of what we see these numbers up here able to achieve. If we end up having less money in the certificates of deposit, it's possible that we'll see a little bit more dividend growth, but also it's possible that we'll be investing into stocks that do not pay quite as high of a dividend yield. So there's a couple different things there. But, if with any luck, if it's a good year, which I'm a little bit hesitant to say it would be, it's possible that we could actually get to the point where the account is generating on average $1,000 a month of dividend and interest income. So income growth in traditional IRA and the Roth IRA has seen more volatility than Jane's portfolio, but overall it's still managed to produce a double-digit income growth over the last 5 years. We think it's reasonable to assume that 3 to 5%, just like with Jane, is the most likely scenario, and so we would be looking at somewhere between 5.4 to 7.2% in the traditional IRA, and then the Roth IRA could be somewhere around 14 to just under 16%. So John does have less money in CDs and money markets than Jane does, and that means that more of his income is eligible for dividend increases, which is also part of the reason why I would expect potentially that we might see it even be on the 7% side, is because if you have more of your holdings that are eligible for increases, then that does increase the potential that you'll see a higher amount of growth from those dividend increases. But also the difference is that the stocks that John has, it is possible that he is missing out on yield when it comes to like certificates of deposit in the money market, because if he's yielding 3% on a stock, but when he could be getting 5% on a CD, that is something that does have to be taken into consideration, because that 3% CD could grow for years in terms of the dividend increase and still not reach that 5% mark that certificate of deposit is paying. So unless we're seeing really strong values or really strong buying opportunities in terms of stock price undervalued, therefore dividend yield is higher than it would otherwise be, that entry level point on the dividend yield is going to be a major factor as to whether or not we're adding more shares. And then also, when we do have some stocks that are yielding 3% or so, it's possible that we might be reducing or eliminating those positions in order to move money over into the money markets and CDs, much like we did with Jane in her traditional IRA. So yeah, thanks everyone for watching. Let me know if you have any questions, comments. Again, love any feedback or thoughts that you might have. I'm trying to condense these videos. This one will be under 10 minutes, so I'm pretty stoked about that. But really appreciate everyone who's taken the time to subscribe and follow me. Appreciate it. Have a great day. Bye.